Good morning and good evening, everyone. Today, in our We Leadership interview series, we're joined by Professor Partha Mohanram from Toronto, and he is a celebrated professor in finance and accounts. He's done his PhD from Harvard Business School. He's worked for Stern University and then moved to Canada, settled in Canada. Before that, he was an MBA from IIM Ahmedabad, and he was also BTech from IIT Madras. So the best of the institutes, from engineering to MBA to PhD, and best of the jobs, celebrated career, one of the top guys in his field in the world, and we have the luxury of listening to him, learning from his wisdom, and I'm sure that my friends, colleagues who've been following our series will be greatly benefited from his wisdom. We're going to focus our attention today on his experiences as well as the impact of economy on stock markets and on startups, etc. So a lot of interesting conversation ahead. Please hang on and please stay till the end. With that, welcome Partha on the show.
Oh, thank you very much, Prashant. It's quite an honor to be on your show, and I look forward to your questions, and hopefully I'll be able to answer them to the best of my ability.
That's the humility of Partha, as you should. And to be on the record, both of us were classmates at IIM Ahmedabad. And Partha, you've been to IIT, IIM, Harvard Business School. How did you make sure that, and you always had fun, and you were always top ranker student in every institute and university. But despite all those academic pressures and competitiveness in these institutes, how did you make sure that you always had fun?
That's a very good question, Prashant. So firstly, I want to correct you. I was not a topper in IIT. Okay, IIT, I would say in the top 1/3 of my class. Because remember, IIT CS is super competitive, right? Like, these are all people in the top 100 JE ranks and stuff. So I had no ambition of being a topper in IIT, and I knew my station in life. So I was quite happy to do reasonably well. Because in every place, right, I've always believed in the importance of being an all-rounder. So I never missed any opportunity to do any kind of extracurricular activity, whether it was sports or cultural and so on and so forth. So if you remember, even in IIM, while I was what they call an ICE call, which is the honor given to people who are in the top 10% of the class or whatever, I was not one of the toppers. I wasn't like one of the academic gold medalists. But I was the all-round gold medalist because my academics were good, but I made sure that I, excelled in all the extracurricular activities, whether it was sports or quizzing or, other sort of cultural activities and stuff. And I think that's very, very important because it makes you more multidimensional as a person. So I've always, in everything I do, right, I have tried to, and this can work for some people, it may not work for other people. I think breadth is often overlooked in favor of depth, right? People become like subject matter experts and they only learn stuff which is of immediate relevance to them. And I think that's very, very myopic. You should never, ever kind of steer away from opportunities to learn things, even if it might not be of immediate relevance to you, because it just makes you a better, more well-rounded person. That's just my perspective.
No, that's really fantastic. That's really fantastic. And how did this being an all-rounder help you in your career in the last 25, 30 years?
See, I don't know if it has helped me directly, but certainly it helps me in the following sense that, whether it be in my teaching or my research, right? I'm never narrowly constrained by whatever is the immediate topic at hand. I can always draw linkages to things which might be from other dimensions and stuff. So, for example, when you're teaching stuff and you want to explain a difficult concept and you give students an analogy from something totally different, it could be an analogy from history or geography or politics or whatever, to explain something, as mundane as accounting or valuation or something like that, right? It just makes you a more effective teacher. Similarly, when you're doing research, it allows you to be more open to doing interdisciplinary research which might, so I'm technically in the accounting area, but most of my research is at the intersection of accounting, finance, and strategy, right? So I don't like constrain myself or conscribe myself to say that I am an expert in this or I'm an expert in that. I just work on whatever I find interesting and try to make sure that I kind of publish these in like top academic journals, and also, make sure that my work is sort of practically relevant to practitioners in their field and stuff. So it's not just kind of what they call ivory tower academia or whatever. So
your academics, your research, your teaching has become way more practical and realistic because of the multidimensional personality that you could develop while you were studying.
I think so. I mean, I certainly believe that. Yeah.
That's really so nice. No, and across these absolutely top of the line institutions in the world, you and all the academic career thereafter again in the top of the line universities in the world, you would have interacted with multicultural faculty, peers, and multicultural student body. How did you manage to effectively do it? What was your learning, and how did it impact your teaching, your personality, your way of thinking, your way of working, your way of life?
So I think it's just the same sort of concept. The main thing is openness, right? So openness to people who look different from you, whose names sound different from you, whose background, whether it's religious or socioeconomic, geographic, or whatever, is different from yours, right? And the great thing about, and this is something which is true for me even growing up. I grew up in Mumbai or Bombay. I studied in the school called Campion School, where we had students from every part of India. Bombay is Bombay is like it's called the New York of India, right? So we had South Indians, we had North Indians, we had Hindus, we had Muslims, we had a lot of Parsis, we were a Catholic school, so we had Catholic students, we had Sikh students, so it was really a melting pot, right? And you just realize that people are people, and the same thing continued in IIT and IIM, where again you interacted with people throughout the diversity of India, right, which is pretty diverse to begin with. And then, of course, you go to the US, or in my case, I went to Harvard for my PhD, right? And then that becomes international. So you start meeting people from different parts of the US. You meet like white people, you meet African Americans, then you meet people from China, from Korea. One thing about academia is it's super international, right? So your professors are from all over the world. And that continued in my academic career. So I was in the Stern School of Business in NYU. Then I was at Columbia for like 7 years, and now I've moved to Toronto. And I don't know, you told me you haven't been to Canada, but Toronto is by some accounts the most multicultural city in the world. So less than half the population of Toronto is born in Canada. So more than half the city is consists of people born elsewhere. So with a large number of people from South Asia, East Asia, Eastern Europe. So all of that, right, just makes you a much more open person, and you just learn to deal with people as people. And I think that's the most important thing.
Are people really different, or they just look different?
That's a wonderful question.
Are their motivations different? Are their preferences, realities different?
So, that's a very difficult question to answer. I don't think people are inherently different. If you think about what an average person wants, average person just wants things like he wants stability around himself or herself. He or she wants, I should say. They want the ability to work in a meritocratic society. They want to have the sort of guarantee that if they put in their end of the bargain, the right thing will happen for them. And basically, they want to make sure that it's a level playing field. I think that's the impression I've got from everyone. So, and one of the things which really opens you up when you come abroad is the sort of petty, narrow biases that you have, right? They just kind of disappear. I'll give you an example. So we have a lot of like rara patriotism in India, especially if there's like India-Pakistan cricket match and stuff, right? And out here in academia, I've had some really, really good friends who are from Pakistan and Bangladesh and so on. And we realize that there's no difference. We speak essentially the same language. There may be differences in sort of religion for some of us and maybe eating habits and all, but it's humans are humans, and you interact with them and you have a great time. So I've had PhD students I've been the committee chair. In fact, I've had PhD students who've been from Bangladesh, from Iran, from South Korea, from India as well, of course, from China. So, and occasionally a few from the US as well. And this will itself will tell you how sort of diverse academia is, and of course Canada. So I think people are the same. People are fundamentally the same. Obviously, people are colored by their background and their experiences. So, for example, this is just, and I don't want to criticize anyone and stuff. Like some people I've interacted with from China, right? It's kind of shocking to me that these are smart people in academia, where the whole thing is you look at data and you question facts and stuff, but you cannot have a conversation with them about, let's say, Tiananmen Square or 1989, because they just toe the party line. And part of it may be out of fear or whatever, but it's like, but I've also met a few Chinese people who are not that way. They just, tell me that this is all complete BS and, there's a lot of indoctrination going on and stuff. So I think some people are certainly colored or affected by the kind of education or the environment they grew up in, but doesn't mean that people can't change their minds or opinions, as time goes by.
Now that's really so nice to know and enlightening, especially for a lot of our professional friends whose companies are trying to globalize. And for them, this insight and understanding will help them a lot in planning their ventures. Now, coming to the next thing, now the world of late, we've seen bars in the past also, but they have been, they appear to be a little bit of a history, but they've resurfaced with the Ukraine war and then this whole clashes between Israel and Palestinians. What will be the short-term and long-term impact of these wars on oil prices, on inflation, GDP, stock markets, valuations?
Wow, Prashant, that's an impossible question to answer. And frankly, I'll try to do the best I can. This is not exactly my area of expertise, right? So there are a bunch of our other batchmates who are much more into things like commodities. And so who would be better placed to answer this question? But it's interesting, right? So initially when this war started, people thought oil prices are going to like double and stuff. The last few weeks, we've seen oil prices declining quite a bit. It just goes to show that, any kind of prognostication is a fool's errand. It's just extremely difficult. Now, obviously, these wars are a big drain of resources for many of the countries. And in a sense, it's money that could have been better spent on human development. I don't want to get into the rights and wrongs of this Israel-Gaza war, okay? I'm happy to get into the rights and wrongs of the Ukraine-Russia war. I think there's no doubt there that there is an aggrieved party, Ukraine, which was just attacked by Russia because Putin wants to redraw the map of the old USSR. But in this particular case, two facts remain, right? Israel, which obviously has a right to exist, was brutally attacked, and 1,200 people were massacred, and 250 people odd were taken as hostages. So that's fact number A. Fact number B also is that the Israeli response, in the eyes of many, has been much more than proportional. And you can argue about the facts and whether the numbers are exaggerated. But they say 16,000, Gazans, mostly women and children, have been killed. Now, just think about, eventually this thing will settle down in whatever kind of unstable equilibrium it settles down in. But all this money would have to be spent on just rebuilding a basic level of infrastructure for Gaza, right? Just think about the waste of resources in addition to the actual resources spent on the actual war, right? If all that money had just been done to just further the peace process in some way, through investments and stuff, trying to get, like I said, people just want the stability of a job. They also want some sort of dignity and, some sort of sense that my vote or my say counts on a day-to-day basis, right? So all that kind of matters. So in terms of long run, see, given that thing is still a little localized, right? I don't think Israel Gaza is going to become like a World War III or anything like that. It's just going to be a localized thing. It's horrible for the people out there. I don't think it has huge macroeconomic implications for the world at large. So, like you said, the oil prices. The recent news is there's been a massive increase in shale, production in the U.S., which has led to a downward pressure on oil prices. So it's very difficult to sort of draw a straight line from A to B and say that because of this war, it's going to have this kind of impact on oil prices, which is going to have this kind of impact on inflation and interest rates and all. I think it's very difficult to make that kind of conclusion or connection. That's not really an answer. I apologize. That's just a bunch of rambling facts. But I'm firmly of the opinion that any kind of forecast is just a wild guess. And obviously, some people will turn out to be right and they'll be hailed as gurus. But most people will turn out to be wrong, which is why it's best to just look at the facts and not worry about making, very, very broad or very, very specific, I should say, forecast.
In your view, this whole US slowdown, their bid to control inflation, which has led to at least a sense or impression that there's a slowdown in US. Is that going to impact the global economy, or is that going to be contained in US?
Well, firstly, for all this think of slowdown, I know that the most recent statement from the Fed was that expect interest rates to be cut. But that's in the aftermath of like sort of record increase in interest rates in recent times, right? So the US economy has actually been growing pretty strongly post-COVID. In fact, I think the US economy recently has grown at like 5% plus annualized in the most recent quarter. And in comparison, like, Canada, where I lived, had like a contraction of like negative 0.5% or something in the last quarter. So, of course, all of this is, because of steps taken to contain rapid growth by increasing interest rates, but the US grew in spite of that. So I think what they're foreseeing is storm clouds in the horizon, which is why he has forecasted a kind of cut to interest rates and things. I think part of it also is a fear that, if interest rates rise further, it's going to put pressure on homeowners and stuff. And so he wants to cut interest rates to get the mortgage rates to be more manageable and so on. Also, you must understand that all these countries, for all this big talk of slowdown and stuff, they're having record low unemployment rates. So it's not a typical kind of slowdown where interest rates are like unemployment rates are high and people are on the streets and miserable and stuff. Unemployment rates are ridiculously low. Just talk to companies. I know you've been in the HR field, right? Talk to companies that are trying to hire. It's incredibly difficult to hire. The supply just isn't there. Part of it is because this is exacerbated in countries like the US. If you look at the Western world in general, in fact, something all over the world, the biggest myth in the world is population is increasing and it's going to destroy the planet. Well, the planet might be destroyed, but it's not going to be because of increasing population. In fact, the worldwide trend is of population declines, with the exception of a few countries in Africa. Even India is basically at just above replacement rate as far as fertility is concerned. I believe it's down to like 2.3 or something, and 2.2 is like, and every segment of society, even in the poorer states, even in like what we call the backward communities with less education and stuff, there's been declining fertility. So in the Western countries, I believe the native fertility rates are like 1.2, 1.3, 1.4, which means unless you have a robust system of immigration, you are going to have declining populations and aging populations, which is going to wreck things like social security systems, healthcare systems, and so on and so forth. So the only way to get out of that is to have a robust system which encourages immigration and allows immigration to assimilate. So in a sense, you have multiculturalism that works, right? US has always had that. And Canada is, in some sense, the exemplar of that. But the US in the last 7 or 8 years, ever since like the first Trump administration, and I say first Trump because there's fear of a second Trump administration, but anyway, there's been a hostility towards immigrants, right? And immigrants are the sort of soul and the dynamism of the US economy. Prashant, you should know that both your sons are highly educated and they are contributing to the strength of and robustness of the US economy. Imagine how you feel as a parent when politicians are like making someone like your sons, blaming them for whatever ills they see in society, right? So I think the bigger problem is that economy might be affected because of if you're not able to hire people, that's an opportunity loss because that's an entire set of economic activity which could have taken place, which is not going to take place, right? So I think that is the bigger issue and the bigger challenge which is going to be affecting this thing. Now there are other challenges. I'll give you an example of Canada, right? Canada has always been open to immigration. Last year, I think Canada allowed 500,000 immigrants, which is a huge number for a country of population of just under 40 million. I think it was more than half of what the US allowed. And the US is a country which is 9 times as large. So per capita, it's like 4 or 5x. But the problem with that is when you allow that many people in, you got to ensure that you have jobs for all of them. And you've got to ensure that you have housing for all of them. And so Canada's had this crazy run up in housing prices, mainly because of an imbalance of supply and demand. So public policy is one of those things where it's like a recipe. If you're making like a sambar or a rasam, right? You have those 5 or 6 spices. You can't just toss them in. You got to put them in the right proportion so that what you end up is not just edible but also delicious, right? So otherwise you can end up with a disaster. So I think that's something that many of these countries are facing.
That's really a very nice analysis, and I think that's eye opener. Now coming to startups globally, and I think the biggest centers for startups are US and India. Of course, China, but China is difficult to analyze and comment on. And in addition to US, India is Israel. And all these countries are facing funding winters, which in a way is good, in a way is bad. But I think it's more good than bad because the focus is now coming on profits, business model, a robust business model, than mindless growth and revenue, and creating business models which may never be profitable. Do you think, is this good? Is this bad? And do you think, will this sustain, or once the money is back in the market, we'll be back to revenue growth and valuation without bothering about the business model and the profit?
So let me answer your second question first. Yeah, I believe that once the money's back, people will go back to this mindless thing because that's what people always do. So when people are looking at valuation in startups, right, it's very often these companies, whether it's venture capital firms or private equity firms and stuff, venture capital more, I would say, there's not as much rational valuation going on as much as people are buying a bunch of lottery tickets, right? And you hold a portfolio of lottery tickets, hoping that one, for every dud you have, or even for 99 duds you have, you get one massive multi-bagger like Facebook or Google, or in the case of India, like you get a phone pay or something, right? Whose multi-billion-dollar valuation will take care of all your duds. So when you have a situation like that, you're obviously not looking at very, very detailed forecasts of revenue and profitability and stuff. You're just looking at something like, is this going to become a large enough market? And is this player going to be the dominant player in this market? Because in that case, then it's worth investing in this company. And you're taking a hedge on that, or you're taking a bet on that. And those things are very difficult to do with numbers. Okay. Now, obviously, the problem is you've got to make sure that you end up with those kinds of firms in your portfolio, right? So the problem is you have this thing called a unicorn, right? And the whole thing is, this is all based on just blind hope. like, this so and so company gets $1 billion valuation, and you have a bunch of, I believe Bangalore has like dozens of unicorns, all of them in like Shajapur Road or something like that. Right? Even small section of Shajapur Road has a dozen unicorns and stuff. But you should also remember the unicorn was a mythical beast, right? Which didn't really exist. And that's what's going to end up with many of these unicorns. Some of them are going to become massive, like maybe like PhonePe and stuff. But some of them are just going to disappear. So I think it's very important to try to invest in companies which are not just generating revenue, but even if they don't have profits right now, they clearly have their. So sometimes, see, the word profit can also be affected by things like accounting, right? So for example, you may have like fixed costs and stuff, but at least if you're cash flow positive, if you're not burning through cash, where your only success is to get to the stage where you can convince the next set of people to give you like $200 million more at like a $5 billion valuation or whatever the case might be, so that you can keep this game going. As opposed to a company which, while it's not profitable, is at least generating revenues. And with each successive dollar of revenue, the margin is getting better. It's not, even if it's not a positive margin, you're at least sort of approaching profitability and stuff, right? So I think insisting on profitability for an early stage venture might lead you to not invest in any company and you'll completely miss the boat. But on the other hand, completely being divorced from this notion of profitability, or at least a trend towards profitability, is also not the way to go. So you've got to have this right mix between these two.
I think, yeah, that's really fantastic, because uh, every business cannot be profitable from year one. If that happens, then the growth will be stymied. But as long as the business model is robust enough to generate profits at a predictable future time, that should be good. But you're saying that, all this is while the money is not there. Once the money is back, old habits will resurface.
Absolutely. So, for example, I teach like a course called Business Analysis and Valuation, and part of the course is looking at accounting issues, right? Looking to make sure that the firm you're analyzing doesn't have any accounting bombs in it, right? Such that things that are completely fraudulent and stuff. So what ends up happening is, if you're in an environment where there's been an accounting scandal recently, so if you're living in a post-Enron world or something like that, or the post-financial crisis world or something, people will pay a lot of attention. But once that has passed, it'll go back to business as usual. So if you've ever driven a car in the US interstate, okay, if there is a cop who has pulled over somebody and you can see the light flashing in the distance, right? Everybody will slow down to like 65 miles per hour or whatever the speed limit is. Maybe you go like 67 miles per hour and stuff. But you go 2 miles beyond, you start stepping on the gas again and driving at 75, 80 and stuff. That is humans. That's human nature. This notion that things work very, very rationally and stuff. Every decision is being made by a human being. Of course, in this pre-AI world, AI is a different issue. But so as long as that happens, human beings are going to be subject to the same kind of biases, and you're going to go back to business as usual.
Interesting. So this behavioral economics has always prevailed over the classical economics, and that takes over.
See, I see. The thing is, I'm not an expert in behavioral economics. What I'm an expert is, I've done a lot of work on valuation, right? I'm certainly not a believer in like efficient markets in the sort of complete sense of like completely efficient markets. That markets are always rational and they take into account every single piece of information. And so, because if that was the case, it would be impossible for anybody to, for example, be a stock picker, because then everything should already be impounded. Every stock should be fairly valued. But a lot of research shows, and by the way, people use this as an example. They say, hey, look at the fact it's so difficult to consistently beat the market. Only very few people have done it, like Warren Buffett and a few other people and stuff, or some hedge fund guys and all. But most mutual funds actually lose money, right? So how is that inconsistent with efficient markets? I'll say that is more a sign of the fact that people are really stupid and make bad decisions. It doesn't make markets like efficient or whatever. It's like, but I've done a lot of research which shows that markets consistently underestimate certain things, overestimate certain things, over extrapolate current results. So there's a lot of research which shows that markets are inefficient. But markets are what I would say adaptively efficient, in the sense that if you let the market know that there is a certain inefficiency, that will get arbitraged away. So, for example, there's been a lot of research which shows that when people like me publish a paper which shows a certain inefficiency, after the publication, that inefficiency declines because many of these people who work for these hedge funds and all these stuff, they're following the academic research. So I might not be getting rich, but a bunch of people are getting rich on my research, basically. But that's fine. This is a choice I've made. I enjoy doing what I'm doing. And but again, this goes back to the notion that markets are not perfectly efficient,
and that is true in the startup world as well.
Oh, it's especially true in the startup world, because when you say efficiency, it's always a notion of informational efficiency, right? In the world of startups, information is highly dubious, because remember, you're dealing with companies with very less of a track record, unaudited financial statements, and it's all about extrapolations into the future. Prashant, I'm sure you've seen these business plans of companies which right now have a shed, okay, and 3 guys. And year 5, they have revenues of $5 billion and a 15% market share in some vacuous market which doesn't exist, right? How do these guys come up with some of these numbers? They just made it up on Excel. Like, there's to give you an example, right? There used to be a very famous show if it's okay, I'll use a little bit of Hindi, right? There used to be a show called Nukkad, which, when we were growing up. And there's
I do remember.
There is a character called Khopdi. He has to borrow some money because he's a beggar and he has to pay the local mafia. He needs like 50,000 rupees. And there is a local bank which has decided to support local businesses. And he says he starts a business called Atma Service Center. And the logic is, when you give money to a beggar, it helps your Atma. So he's providing the service of Atma Service Center. He has his plan and all. The problem is he doesn't know how many zeros that there are in 50,000. And this, I don't know who the beggar is, but Khopdi is that drunkard who's next to him. And he says, "Arey, isme ek Mendi kam hai. Mendi is zero in Marathi." So he ends up asking for a loan of 5 lakhs or 50 lakhs and all, because he doesn't know how many zeros there are in this. So my sense is many of these business plans for startups follow a similar philosophy. Like, there's absolutely no science behind it. They have some sort of an idea. It's basically this Atma Service Center kind of thing. And they always say, "Isme ek mendi kam hai aur ek lagao." Like, that's basically how valuation works in the startup world also.
And with very learned people in the venture capital, etc., can't they see through this?
It's not that they are not seeing through this as much as, like I said, they are looking at it more in the sense of there is this huge amount of FOMO in all of this, right? Fear of missing out. I don't want to miss the bus. I want to make sure that I have this new Willy Wonka's come out. I have the golden ticket. All these kinds of things. That fear is there, I think, and that's what is driving a lot of these valuations in this area. I mean, I'm not trying to throw a whole bunch of people under the bus. Like, a lot of people have been incredibly successful in this area as well, but a lot of people have not also, just to be honest, right?
So not since you also gave a course in this area, does it make sense and is it at all possible to have a academic framework of valuation for startups? And should it be based on revenue growth, market share, profit, or some combination of it? And which then gets so popular that all venture capital firms are forced to use it, and anybody who's not using it should have the FOMO.
No, I don't know if that is possible also, but all I think is you should not. Firstly, you should have multiple ways of valuing a company. So how a company is valued? You can value a company using. So it always depends on forecasted numbers, and from the forecasted numbers, you can either do a formal valuation, like you can do what's called a discounted cash flow, or I use this model in my course called the abnormal earnings valuation model, or most often people use multiples, right? And this multiples based valuation is extremely dangerous because it's like they say other deals have had a multiple of 10x or 20x of EBITDA, and that to forecasted EBITDA. So I'm going to use something similar. So, but that other deal could have also have been overvalued, in which case you're just propagating the overvaluation to this particular deal as well. The other thing is very often people use these numbers like EBITDA. No, they won't use GAAP earnings or even cash flows. They'll use EBITDA. The problem with a number like EBITDA, right? It's earnings before interest, taxes, depreciation, and amortization. It, in a sense, says that these things like interest, taxes, depreciation, and amortization don't matter. But in reality, they matter a lot. So there's actually a very, if you remember, Warren Buffett's associate was this guy called Charlie Munger, who just passed away like a month ago. And there's a video floating around of him just talking about how EBITDA is like the most dangerous and evil thing around. And that's something I completely agree with, because it essentially says, EBITDA is earnings before bad stuff, things which make my numbers look so. And also remember, EBITDA is a larger number by construction than, let's say, bottom line earnings will be, even if both are positive, right? So when you say it's an EBITDA multiple of 10 sounds like a reasonable multiple. But what you don't realize is you're taking a multiple of a larger number, right? So eventually, shareholders don't get EBITDA. Shareholders get a share of post-tax, post-everything profits, right? In their future cash flows or whatever, whether they get them as dividend or whatever. So that is the danger of using some of these metrics. So if you're valuing startups, I think the main thing is no single valuation number is going to give you the right answer. So you should use multiple valuation numbers using conservative estimates. So I think the bigger problem, more than even startups, is in the case of M&A. Companies make really, really bad. Most M&As lose money. They lose money for the company acquiring, but they often make lots of money for the acquired company because it's very happy to be acquired at an overvalued price. And of course, they make lots of money for investment bankers and lawyers who are facilitating the deal, right? So because they are dalals, they are purely getting money on the transaction. They don't really care about whether it's a transaction that makes sense or not. Similar thing happens there when people are trying to value this thing called synergy. How do you value the synergy in a deal? So they'll come up with, oh, we'll have cost synergies of $5 billion and we'll have revenue synergies of $6 billion. And you start asking them, how did you get these numbers? And how many years is this synergy going to last? What is the discount rate you have used for these synergies? And you start digging into that and you realize that these things it's like a house of cards. It's so optimistic. And even with those optimistic numbers, the value of the synergy is already built into the premium you've paid. So if you already paid a $20 billion premium to what the company was trading at, because of the so-called $20 billion synergy, well, that entire synergy is going to go to the acquired firm's shareholders. You're going to be left with, like, at best, a zero NPV project, and most probably a negative NPV project, because the $20 billion is never going to show up. So, and to say nothing of the sort of accounting issues which might have boosted up the performance of the company, which is like trying to make its numbers look good because it wants to be acquired. So I think this whole valuation and bad valuation decisions is rife not just in the startup scene. Where startup scene, it's kind of understandable because these are all private companies. It's highly speculative. But this is also true in the M&A space, very often in the acquisition of public firms where you don't have an excuse also.
So, why do then M&As happen? I agree with your observation. I have also rarely seen an M&A creating value.
So why do M&As happen? Listen, one thing you'll realize from this interview so far is I love giving analogies, right? Suppose you're a rational person and I tell you that 46% of all marriages end in divorce. The question you might ask is, why do marriages happen? Because everybody says, well, I'm not going to be the one who is going to have a divorce. So, like, if you tell somebody that M&As fail for reasons A, B, C, D, companies will say, well, the A, B, C, D don't apply to me. So there are a lot of reasons why M&A happen. People say the biggest reason is this thing called the hubris hypothesis. Okay, it's a very famous behavioral economist called Richard Roll, Nobel Prize winner from Chicago. He has this hypothesis called the hubris hypothesis, which essentially says managers consistently overestimate their own ability and underestimate the difficulty of a task. So when you say a company which needs to be acquired, and let's just say there's lots of costs associated with integration and fixing the problems in that company, you will consistently underestimate those costs and overestimate your ability to do those things. So essentially, what will end up happening is a negative NPV project will become a positive NPV project because of the assumptions you've made. Also, if you're a company which has lots of resources at your hand, like just think about your own like life decisions, right? When we were in IIM, we had limited amounts of money and we decide to go out to eat. Let's say we don't like mess food and we want to go to like Lutf across the road, or we want to go to Bishala and stuff. We got to think and say, isko 100 rupees hoga. How much money is left? Can I go this week or shall I go next week? But think about it right now, yeah, Prashant. Let's say you come to IIM on campus reunion. Do you even think about let's go to Vishal? Let's go and it is 2,000 rupees. Let's go and eat. Why? Because that money means less to you now. Companies are the same way. If companies are constantly resource constrained, right, they will think more about these decisions. But if you're a company which is wallowing in cash, and cash could be in one of two ways. You could have lots of cash on your balance sheet, which is why institutional investors want companies to pay back excess cash, because they know if there's excess cash on the balance sheet, companies will make these bad decisions. That's why they insist on like larger dividend policies or like, repurchase programs or whatever the case might be. The other thing is your own stock price. If your stock is overvalued, that is like cheap currency. So when companies are overvalued and they know they're overvalued, they go on acquisition sprees because they know that they can use their overvalued stock to buy other assets. So I'll give you an example. AOL Time Warner merger happened in March of 2000, just before the stock market crashed. AOL was a really small company, okay, probably had $5 billion of revenue. Time Warner was this massive company, but AOL acquired Time Warner. So $300 billion merger. The relative valuations of 160 for AOL and 140 for Time Warner. But if that same deal had happened like 5 months later, AOL stock price would have crashed from 150 to like 10 billion. Deal would never have happened. So even though it's considered to be one of the most disastrous M&A in the history of M&A, think of it from the AOL shareholders' perspective. They got a fantastic deal. At the peak of valuation, at the peak of this internet hysteria, their CEO, Stephen Case, was able to exchange their airy-fairy fictitious assets for some real assets, right? So it's all a matter of perspective.
That's fantastic. And the question I had about startups. Now, some of the investors believe that startups should be market leaders in their home country before they go out to other countries. Now, while that was certainly very, very true 30 years ago when C.K. Prahlad had come up with this concept, because the internet did not exist and digital marketing did not exist, etc. Do you think that continues to be a relevant philosophy in today's world?
See, I think to be fair to C.K. Prahlad, and he's a gentleman actually, interestingly, when I finished IIM, right, I had a choice between going to Michigan and going to Harvard. And so he was at Michigan, but he was a Harvard guy, right? So I actually spoke with him because, he used to consult with the TVS group and my uncle put me in touch and stuff. So he's really a great guy and was a great guy. He died very early, sadly. I think to be fair to Prahlad, his idea about core competence is more about sort of lines of business. I don't think geography was a big aspect of it. I think he has no issues with companies expanding to his point was you should not be in industry A, industry B, industry C, which are unrelated, because there's no reason for you to do that. You should focus on your core competency and you should kind of excel in that. See, I think it's less important now simply because of things like the cloud. And so I'll give you an example. So one of my IIT classmates, his name is Sudhir. He has started this company, which is now actually a unicorn. It's based in Seattle and Hyderabad. It's called Zenoti, Zenoti. Okay. So these guys provide software solutions to the fitness, spa, and salon space. So basically, this whole thing started because Sudhir was he's a serial entrepreneur, ex-Microsoft guy. He had a company and then he had an exit, and then he was just chilling in Hyderabad, and he bought a gym and he bought a spa. And then he realized that the kind of software he needed to run that spa and gym effectively, he was in that tweener space where he was too small for the big guys like SAP and Oracle to do anything for him. And the smaller people were not providing him solutions. So he actually wrote something himself. And then he realized that, man, there is this whole space here. He sold the spa business and the fitness business. He started a software company focusing on these, based in Seattle. And so he basically is based in Seattle, and he's doing incredibly well. And they're like, but to be fair, and they've got like amazing valuation, multiple rounds of financing and stuff. To be fair to Sudhir, right, he has consistently shown positive revenue growth and a trend towards profitability, and he might even be profitable right now. But even though he's based in Seattle and development in Hyderabad, they have clients in multiple countries because it's a cloud-based thing, and they are also so they provide very, very customized solutions to the particular person. About like it's also about things like booking appointments as well as replenishing supplies, and so it's totally customized to that space and customized to the client. And so that's an example of a company which he's not focusing on just the US market, or from the US you go to Canada and Mexico nearby. He has clients in Europe, he has clients in India. He has, like, for example, I think the Lakme studio in India is his client and stuff. So there is no reason for him to constrain himself. That, I think many of those things are back in the 1990s and all, when we were in the sort of the earlier generation of manufacturing. Now we've gone beyond that to services. More and more than services, we've gone to things like cloud and Internet of Things and stuff, right? So I think those kinds of physical barriers mean far less. But I think his basic idea of don't be everything to everyone is still valid.
That is certainly very valid. No, I was just saying that this whole being a leader, I mean, a lot of industrialists in India have also in the past said that, first be a leader, like to grow in your market before you think of stepping out. But I just wanted to know your view, which you very, very clearly expressed, on with the change in internet availability and digital marketing, etc. Does that hold true, or can startups think of going global without having to be a leader in their own market?
I think the most important thing is don't overextend yourself. But you don't necessarily need to be a leader in your market, but at least you need to have, your source of growth cannot be, can I con the next guy into giving me funding? Eventually, the most successful startups are the ones which are bootstrapped. Like, if you look at our own classmate, Deep Kalra, right? Deep Kalra, like, he bootstrapped his startup and now he's like a dominant player in the, obviously, he's had some mergers with like other companies and all, but still, Make My Trip, he completely eschewed the financing from external people because he ensured the company was profitable from the beginning, right? Or from the early stages or whatever. So I think that's the most important thing. It's not about what you do to convince fundraisers and to get like multiples and get Series A, Series B, and all that is great. But eventually, if you want to succeed as a startup, you either have to have a plan towards profitability, or you got to have a plan towards make yourself attractive enough that some other larger companies will buy you. Because that is certainly a valuable and a viable form of exit, right? You don't have to think about going public or like, all that stuff. But you have to make yourself attractive, because the thing is, it's a two-way street, right? Larger companies acquire these startups not for anything else, but simply because they don't necessarily have the innovativeness and the agility that these startups provide. This is extremely common in the tech sector, right? I'm sure, like a Microsoft or a Cisco or an Oracle or all these companies, they probably make hundreds of acquisitions, very small acquisitions, like 5 million, 10 million, 20 million kind of thing, throughout the year, right? Because what they're acquiring is they're acquiring a little bit of technology, which is going to help them in their next, product or the next service or whatever it is. And so, as a startup, you've got to make yourself either attractive for the next round of financing or attractive to the potential company which might acquire you. So, and the way to make yourself attractive is, see, very often these guys they're looking for something unique. They're looking for technology that you have, which they don't have, or they're looking for some presence in a market that you might have. So
That's really nice. And I think startup founders like me are going to hugely benefit from this discussion and all your insights about the current valuation methods and the future valuation methods and what startups should do and how bootstrap startups have been most successful compared to funded startups. That's absolutely great insights. And I mean, let alone the world, but it has been eye opener for me and a great guidance for me. Now, what would you recommend to startup founders? What are the two things they should do and two things they should not do to succeed?
So Prashant, you're asking this of somebody who has not started a startup, right? And you're somebody who has done it and successfully and so on. So I'm not I've observed it. And I've obviously done a lot of research on not necessarily startup, but early stage companies and all, growth companies and all. I've done a fair amount of research on valuation and stuff. For me, just observationally, right, the biggest thing which makes companies succeed is people, right? And I'm sure you like hearing this as somebody who's been in the human resources field for a large part of your career, right? So I think people underestimate the importance of people. And so I think the really successful companies are the ones which have the best people, which treat its employees and its founders, not just founders, it's like early stage employees and all these people fairly, and provide a good environment where people want to work there. So why do people enjoy working in startups? Part of it is because they think it's, maybe this will become the next Google and I could be employee number 25 in Google. And which means that, I'm going to end up with like $100 million or whatever it is, right? But but in reality, your startup is not going to be Google. Why are you still there? You are there because you enjoy being there. You enjoy doing whatever you're doing. So I think the most important thing in startups for success is people, and how you encourage people or get the right kind of people who work in a team, people who work together and stuff is really, really important. I think the second thing is uniqueness, right? It's no point being the sixth company to do something or do something slightly better, because if you are the sixth company which does something better than the fifth company, the seventh company is going to come along which does something slightly better than you. So the sort of obsolescence factor is extremely high when you're doing something super faddish, or how do I say, the super delta X, if you know what I mean, right? So try to look for something unique and different. And the last thing is, and this is more related to our discussion earlier on, never lose sight of the bottom line. And the one thing I tell people is, and I'm obviously biased because I'm a professor of accounting and finance. If you're a startup founder, right, make sure you understand the basics of accounting and finance, because you're going to be dealing with people on the other side who clearly do understand it. So you want to make sure that the terms you get and the valuation you get is fair and all those kinds of things. So just know what these valuation methods mean, know what an income statement is, know what a balance sheet is, know what a cash flow statement is, know the difference between EBITDA and net income and cash flow. So these are all things that you should sort of know immediately, right? So understand the basics of financials, because then you will make sure that you understand what is being discussed. And these things are all extremely basic, right? But people use big jargons just to kind of project this thing of I'm doing something super analytical and all. It's kind of like going to a temple, right? Where the pujari is saying something actually maybe saying something very simple. But that's in the Catholic Church where they say it in Latin, or in a Hindu temple where they say it in Sanskrit, or in like a mosque where they say it in like, very, very chaste Arabic, right? You feel as though, man, something very amazing is being said, but you need to understand the language which is being spoken. So in the case of finance, right, that language is the language of accounting and financial statements. So I'm not saying be an expert, but be literate. I teach accounting. I'm not an accountant. You know me. I'm an undergraduate in computer science and I'm an MBA from IIM Ahmedabad. But I kind of learned this stuff along the way. And I think it's absolutely crucial to learn this.
That's great. That's great advice. Thank you very much. Thanks a lot. And with this, we once again thank Partha for his time and for his willingness to share his experiences, wisdom with all of us. And we're definitely going to gain from it. Thank you, Partha. Thank you very much.
Thank you very much for having me, Prashant. And once this thing is ready, please do send me a link.
Certainly, we'll do that. Certainly, we'll do that.